on speed from your side, obviously you were later talk about, but be interesting to get your perspective, if you like, on the things that constitute actually access to speed of promotion.
Well, I think firstly, if we're talking about speed, we've got to talk about a number, right? So, average execution speed on the LMAX exchange is 3 milliseconds. The internal exchange latency is 500 microseconds, and that'll get quicker, but speed is only one part of it, right? So we talk about algorithmic execution. Execution in general is about precision, reliability, and of course the speed and consistency of execution. That's why fundamentally, look, we're exchange evangelists at LMAX. We believe from eBay to the CME, from the LSE to LMAX exchange, liquid products trade best on exchange. Reliable, robust infrastructure is part of that, and speed is also part of that. That enables liquidity providers to protect themselves, and that allows the buy-side customers to execute more often, more frequently, at the price they want to execute at. So Rob was talking about transaction cost analysis there. We believe, we're actually, if there are any other venues out there, we're happy to be compared. We believe that implementation shortfall is best on the LMAX exchange. So if you want accurate, precise execution, trade on exchange. Across asset classes, we think, and that's been proven outside of FX, that exchange execution is the way forward. And one of the key bits of that, of course, is speed.
That debate running across the sort of different market constituents, which also obviously parts back to everybody in terms of the, because we're talking about different stakeholders, if you like, so liquidity providers and liquidity takers. I mean, what's your, does that profile change, do you feel?
Well, I think if you talk to, however many market participants are the real liquidity originators, you'll find that their pricing engines are going to price customer business, customer flow differently based on whether it's anonymous or whether it's transparent. And so I absolutely do believe that it doesn't go across all market segments. High frequency, position-based, market participants that are looking to trade FX for alpha could get better execution with no leakage of information into the marketplace, and that's great. Relationship business that's being driven by what I call primarily liquidity redistributors probably would benefit from more transparency in the marketplace. Transparency meaning they're going to let the liquidity providers know that it's that particular redistributor on the other side of the trade.
I mean, I have to disagree with that, you know that, obviously.
We've had that point of debate actually, so yeah, so I think that's probably.
I mean, come on, I mean, let's look at the spot FX market, right? It trades 50 times the volume of the New York Stock Exchange every day. And you tell me we need dark pools, you tell me that we need to have this opaque OTC marketplace. You're telling me liquidity providers need last look. Come on, look at the internet, look at what's happening in electronic trading. You know how it's going, don't fight it. Surely a level playing field, surely the ability for everyone to access that level playing field on an open order book, like they've done in every other asset class, is the way forward. So fight it all you like, create the dark pools in the short term, in the long term. Spot FX and foreign exchange in total will trade on exchange. ECNs now, platforms you see now will be exchange based in a decade. In my opinion, they should be on exchange right now.
And I mean, in terms of, I guess, the where those natural pools are. So I mean, in terms of, I suppose the low latency liquidity. I mean, again, driving back at the, obviously, an exchange is going to take a view on where. I suppose the exchange infrastructure, but I mean, in terms of the sort of market profiles and what you're seeing in terms of, I guess, where the demand is greatest, is the demand greatest by a client type or by a region, or where you
I mean, if you look at what the banks are doing with their technology there, which is really picking up on the thing that Jakob came up with, is they are getting much more efficient at market making to different client segments. So they're real money clients who are not necessarily gaming their market making activities. They'll tend to put in a separate liquidity stream. They may give them much tighter spreads than you'd actually get on an exchange. So we're just seeing not just fragmentation in terms of venues, but fragmentations in terms of liquidity streams from established, liquidity providers, and that's where aggregation is key. So although I like the exchange model and I'm happy to integrate to exchanges, the reality is that there's just more fragmentation going on at the moment.
Surely not. I mean, you can't get into a spread war in exchanges. By nature, an exchange, I agree with Rob earlier on. I mean, we're not good in 50 or 100 euro dollar today, but we will be. But come on, choice price, top of the book, 5,000 seconds yesterday. That's a fact. Go and check it. So you can't compete on that. And surely, as exchanges develop, look at all the other ones that are out there, then people stream, not just prices, they stream orders onto the exchange. That's a real marketplace. And there's no room for this ECN liquidity provider control you have. So everything is going open.
I think this is where FX is very different from equities, right? So when a market maker in FX is he's putting a price out, or he's putting liquidity out there in the market. So it's almost, it's not real liquidity.
That's the problem, right? Because
that's the nature of the
on
FX
exchange,
market.
stream limit orders is real liquidity. It's there. How do we protect everyone? We protect everyone through price. Cancel and replace 1.5 milliseconds. There's control for the liquidity provider. Ask our 9 liquidity providers growing to double figures. 5 of the major banks, 4 of the best proprietary trading firms. They're happy to stream limit orders onto the exchange in sizes from 500,000 to 10 million right now.
So I was going to actually, as we get down to this sort of debate, it's interesting to understand from the liquidity provider's perspective, you're obviously looking at, because it does change the market as you're saying, David, but why do you think they see an interest in doing this in a sense and moving away from the last look and all the other things that have historically been kind of part of the market?
Well, look, I mean, first of all, it has to be commercial. So they're not going to do it, it's not commercial. All I can say is we've grown our liquidity providers from 3 to, as I say, double figures next month in the last 6 months. Every single one of them streams more orders today than they did 6 months ago. Every single one of them catches more flow than they did 6 months ago. So it works. There was a question on one of my notes with should liquidity providers stream prices to every ECN? Of course not. And they're going to make their choice and they're going to see what's commercial for them. The rules of our order book, the rules of our MTF, we're the only guys who are regulated under MiFID by the FSA as an MTF, which would qualify as a SEF in the US. Under the rule book, no one can have last look. It's a level playing field. So they pay their money, they take their chance. And as I say, I believe if you ask them, they're seeing a high yield on exchange than they see on some of their ECNs. If you look across asset classes, there's always room for brokerages. They're not going to go away. And because we run an exchange that's classified as an MTF in the UK, we hope to have guys like ADS as clients of ours going forward. So they should offer their clients exchange execution, exchange pricing. And that's what's going to happen. Have a look at how the CME was established in the first place. Going back to our DNA, our heritage, we learned a lot over the last 10 years, I say we as a wider group. As a guide, the group that I'm part of currently executes 14 million transactions a day, has 500,000 active customers. So that's how we put the technology.
You just identified the two, right? So if you can solve the latency issue, that's certainly eliminating one major reason why banks were employing last look. On the credit side of things, as you correctly point out, there are going to be times when a bank is streaming prices to a customer, and because of a customer's particular trading patterns, they may exceed a credit limit, and they're going to need the ability to say, sorry, nothing done. So certainly an exchange and margin, if you don't have the margin, you're not able to execute the trade. It's that simple.
You don't need last look for that. That's taken care of with credit and opening limits at the PB, so no.
But when you get to your credit limit and PB and your pre-trade credit check gets executed, you're not going to be able to enter the
We
order.
don't need last look for that. Okay, trade's rejected, you don't have the credit. It's simple. It's not last look.
Ultimately, you want to suppress the amount of liquidity you're showing on a stream in proportion to your credit.
Let's be clear, right? Last look is an archaic concept. Okay, simple as that. You don't need it. As soon as you stream, a price with a quantity beside it becomes an order. That's the price you're willing to deal at. Okay, there's no requirement for last look then. If you stream a choice price and you don't put a size on it, of course you want last look, of course you want the ability to reject. If you stream an order in 500,000, 1 million, 5 million, 10 million, 20 million, the quantity, you have the ability to update that in 1, 2, 3 milliseconds, you're happy to deal there. There is no requirement to put control with the liquidity provider via last look. Simple. I think if you go and ask the banks themselves, if you give them that capability, they don't need it, they don't ask for it. Otherwise they wouldn't stream us prices today.
But I guess the follow-up question David, is actually how much does your streaming profile change through the course of the day as credit gets used up? Or are you completely removing any counterparty credit risk through the margin and then through the exchange model?
So there's always credit risk. So, let's face it, one of the things we offer too, so when we talk about exchanges, there's exchange execution and there's exchange clearing and settlement. So
it's not a real exchange then?
No, it's an exchange. It's a multilateral trading facility which offers exchange execution and 2 types of settlement. One is bilateral clearing for foreign exchange using prime brokers. One is central clearing using the London Clearing House for non-FX products. So on that basis, in the UK, under MiFID, under the FSA, it's a multilateral trading facility which operates exchange execution.
Okay, so I think we're clear on that, but I think the bit that's, which is good, I mean, I think it sounds like actually from all of this that there are roles within the market for each of those different things, because actually...
Just one thing on that, we're just a simple exchange, we just match orders, so we're never complicated. But we have full pre-trade and post-trade transparency. So plug in tomorrow, it's free, every trade is published on Reuters, pick it up, plug in and see 20 levels of depth in any currency pair that we quote. So it's all there, it's part of the rule book, it's part of the rules being a regulated MTF. And I'll pick up a challenge from Jaco, where us guys like Robert at Credit Suisse come measure us. I'm pretty sure that we'd rank highly on TCA.
I think we've got about the sort of 5-8 minutes worth of question time now, so I mean, I can ask more questions, but I'm very happy to open it up to the audience. I think we've flowed quite widely. I think we've got some strong opinions here, which is good. It would be interesting to get some perspective from different stakeholders on the floor as to either agreeing or disagreeing with the views or actually asking questions around them. So do we have any questions from over there, please?
A kind of open question. To what extent is perhaps some of the difference in view built around the different models? So 2 competing models. So one about cooperation and one about exploiting misprices or exploiting the competition. Would that be a fair judgment or assessment?
Which is the latter?
It seems to me that the idea of an exchange, and I may be wrong, is about creating this level of fair play. And what you're trying to do is cooperate together rather than exploit someone else's bad price.
Perfect, couldn't say it better myself.
Do you want the microphone?
No, I can speak up. To what extent is this, there's nobody's really mentioned that there's a vested interest, and I don't pretend to understand it fully, but in the cozy, some people call it a cozy cartel of top-tier banks who had things a certain way, and that is starting slowly to come apart in many ways. And to what extent is this all about that? And to what extent are they trying to push that back and stop that happening?
I think from my side, I think it's done. You can ask the banks themselves. Probably if you asked the question 3 years, 4 years ago, they'd say, yeah, let's protect. Now they're open, they're ahead of the game. So, you know, Robert who stood up there and other gents in and around the room, they've got huge multi-million-dollar tech budgets now. They're ahead of the game. Where the prop shops, where our friends in Chicago led the way maybe 5 years ago, the banks are there. They're catching up quickly. You've got guys coming from other asset classes into the FX world. So I think they no longer need to protect, and now it's time for them to lead.